This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, having endured the trials and tribulations of dealing with opening years with all its different ways and forms, be relieved, because when dealing with closing year rules, as you can see in terms of the note in front of you, it's not very extensive, is it? It's a whole lot easier. Indeed, we will sum it up in terms of a three-step approach to work out what the assessments will be over the closing years of that trade now ceasing to trade. First thing we did with an opening years example was to identify the first tax year. So guess what the first thing we're going to be doing when dealing with closing years is going to be? Yep, don't have to be Einstein for this one. We identify the final tax year. And how do we do that? Well, we identify the first tax year based on the date we started to trade, so we identify the final tax year based on the date that we ceased trading. So there is step one. Identify the final tax year, very obviously based on the date that we ceased trading. Now, once you've identified the final tax year, you note it, you leave it, and you then move to step two. And step two is to go back to the penultimate tax year. If you've now identified the final tax year, whatever it might be, 2021, 21, 22, whatever it might be, if you now know what the final tax year is, you know what the penultimate tax year, penultimate, the one before last. So step one, identify final tax year based on date of cessation. Step two, go back to the previous, i.e. the penultimate tax year, the one before last, and what do you do with it? You assess using CYB. We use current year basis all the way through to and including the penultimate tax year of assessment. So step two, basic, simple CYB for the penultimate tax year. And that takes you to the third and final step. Having identified which profit is being assessed in the penultimate tax year, step three, quite simply, is we assess all remaining periods of profit. Now, notice I say all remaining periods of profit. That's going to be one of two things. It will either be just one accounting period or maximum possible two accounting periods. And that, again, depending on what was your choice of accounting date and what then is the cessation date. So it's easy to do because if you've done the first two steps first, this is just what is left over. So identify final tax year, go back to penultimate tax year, assess using CYB. You'll have a series of accounting year end, assess using CYB in the penultimate tax year. And then any remaining period, it will be one or maximum two, is then allocated to the final tax year. There's just one other thing to do to get the assessment for the final tax year, and it's something you already know about that we dealt with in opening years. What is it from opening years that will now impact on the assessment for that final tax year? And hopefully you remember that, depending on what accounting date you chose anyway, there is probably going to be an overlap profit that arose in those opening years. And what did we say we would do with it? We'd credit it back, we'd deduct it in deriving the assessment for the final tax year. So there therefore are three steps. Now, in terms of the notes, what we have here, the rules for dealing with the closing years of a taxpayer ceasing to trade, very much more straightforward, as we said, than the opening years, with, as we've just said, CYB being used up to and including that penultimate tax year, the penultimate tax year, the one before last. The basis of assessment then for the final tax year is we take the actual trading profits from the end of the basis period for the previous, i.e. the penultimate year. So what year-end profit have we assessed in the penultimate tax year? And all remaining periods of profit, year of assessment, up until the date of cessation, all profits, that should be all profits there, not yet taxed. So anything remaining, allocate to the final tax year. Not quite there, as we said, any overlap profit that we'll now recognise here in closing years as overlap relief. It's a relief because it's going to reduce the assessment of the final tax year. Any such overlap profit is then deducted in deriving the assessment for the final tax year. Right. Let's have a go at a couple of examples just to illustrate how we go about this and what we might find. So I'll give you a moment there if you just want to pause this just to copy down this particular example. I'll read it through for you so that we know what's involved. The taxpayer ceased trading at the 31st of July 2020, having previously prepared accounts to the 31st of December each year. Recent results were as follows. Obviously, we've got our cessation there, period to the 31st of July 20, and then what accounting periods had existed prior to that. Well, the immediately preceding one, the year ended December 19, preceded in turn by the year ended December 18. What do we need to be given by the examiner from our opening years? That, of course, is our overlap profits, 8,000. Now, I said a moment ago, if there are any overlap profits, we've seen one situation so far when there would be no overlap profit. And that was if you chose either, to be very precise, the 5th of April, or more likely the 31st of March as your accounting date. If you did that, then there will be no overlap period, there will be no overlap profit. The only other situation that you haven't yet come across, and you'll see that in the next chapter, chapter 7, when dealing with losses. If in opening years you made losses, there's no concept of an overlap loss. As we'll discover in chapter 7, if a loss arises over those closing years, in the opening years, I beg your pardon, if a loss arises in the opening years, it will be used once. If a period of loss happens to fall into more than one tax year, we know how those basis periods overlap in those opening years, then any loss is allocated to the first such tax year in which it arises. Don't worry, all of this I'll go through with you, of course, in detail in chapter 7. But there's no overlap loss, and clearly there's no overlap profit. So that's the second situation where there may not be an overlap profit. If there is one, then they've got to tell you what it is, as I have done here. The only thing that they could do where they do not tell you is they give you a sort of cradle to grave exercise, i.e. a very short-lived business where they tell you started to trade on this date, opening period to that date. Chose that as the accounting year end, maybe a couple of accounting year ends, and then it ceased trading. A relatively short-lived business. So what you've got to do is to go through the opening years and then go through the closing years of assessments. And in dealing with the opening years, you would be working out the overlap profit for yourself, which then in the final tax year, to get its assessment, you will credit back. You will deduct in deriving the assessment for the final year. Right. Hopefully, therefore, you've paused and you've already got this now written down. Let me therefore take you through the approach. What we said was step 1, we identify the final tax year. And that's done very simply based on the date we ceased trading. Well, there we go. We ceased trading, as we'd originally noted there, at the 31st of July 2020. What tax year does that fall in? That is, of course, the 2021 tax year. So there you go, step 1. It's not difficult, is it? So in terms of step 1, we've identified the final tax year. It is 2021. We do not state now any basis period. We do not now do any calculation of it. We will get that effectively as a balancing period or periods once we've dealt with step 2. Step 2, go back to penultimate tax year and assess using CYB. Well, if 2021 is the final tax year, take one away from it, and 1920 will be the penultimate tax year. Assess using CYB. We have been preparing accounts to the 31st of December in each year. Therefore, which 31st of December ends in the 1920 tax year? And hopefully you're not having a problem with that now. Basic CYB, which 31st of December ends in the 1920 tax year. That, of course, is the year ended 31st of December 19. What did we have for the year ended December 19? A profit of 40,000. That's what we're going to assess here in 1920. And obviously the year ended December 18, that would have been assessed in the 1819 tax year. If they asked us to compute the assessments for all of the tax years as far as the information provided would allow, the earliest we'd go back to is 1819, assessing the 50,000. We've just identified the penultimate tax year as being 1920 because the final tax year is 2021. Using CYB for the penultimate year, we've identified there £40,000. So it was the year ended December 19 where we made a profit of 40,000. Step 2, done. Final step 3, allocate any and all remaining periods to the final tax year and then deduct any overlap relief, i.e. the overlap profits from opening years. Well, we've come as far as the year ended December 19. We've assessed up to there. We've gone that far. There is only one more period that remains as yet unassessed, the period to the 31st of July 20. So, back to our final tax year. It is the period to the, was it 31st of July? Yes, the 31st of July 2020, that was a profit of some £20,000. So we've allocated any and all remaining periods to the final tax year. As I said to you a moment ago, that's going to mean either, as here, 1 accounting period or maximum possible 2 accounting periods of profit. But not yet there. We need to deduct, of course, our overlap profits, our overlap relief, as we will now know it. What were those overlap profits? They were £8,000. £8,000 to be deducted, therefore, so our assessment now for our final tax year 2021 is £12,000. Job done. Now, there's no other ways of doing this. There's no, well, it could be this or it could be that. It's not like opening years, which was such a pain, where there was all those different potential outcomes as we endeavoured to get as quickly as we could from what would always be an actual basis in the first tax year of assessment to a current year basis as soon as it was available. That process could be slightly complicated there, with all the different possibilities we had to deal with. Here in closing years, it's that simple 3-step approach. Okay, now we've illustrated it there with that example. Just want to do one more example. So again, you understand the process that you adopt and you don't decide to go off and do it some slightly different other way that you think is better. Trust me, I don't think you'll find such a way. So, another little example here for you to now make a note of. This time the taxpayer ceased trading at the 1st of December 20. Now, as soon as you see cease trading, you know therefore the 3-step process that you'll need to adopt. And you also know that the step 1 is of course to identify the final tax year based on that cessation of trading date. That very clearly is again the 2021 tax year. We previously prepared accounts to the 30th of June in each year, and then we have the recent results listed there. And of course, as we must have, any overlap profits, if they arose, here were £5,000. So let's go through that process again, shall we? We've already done step 1, identify the final tax year. So here we go. Final tax year 2021. Note it, identify it, and then step 2, go back to the penultimate tax year. Well, the penultimate tax year is 1920. That we will assess using current year basis. What was our previously chosen accounting year-end date? We had been preparing accounts to the 30th of June in each year. So, again that question, which 30th of June ends in the 1920 tax year? That, of course, will be the year ended the 30th of June. I hope you've already written it in there for yourselves, but that would be 19. Back to your figures. Year ended 30th of June 19. There it is. And we have there a profit of £40,000. £40,000 to be included. The assessment is dealt with. Now, they did give us, again, figures going back as far as the year ended 30th of June 18. Again, if required to deal with all of the tax years that the information provided in the question will allow you to deal with, then you know that that would have been assessed in 1819, and that would have been a £60,000 assessment. For what we're trying to do here is to work the assessment for the final tax year. We're now in a position to do that. So, step 1, the final tax year was 2021. Step 2, go back to penultimate tax year, 1920, assess using CYB. That for us was the year ended June 19. Step 3, go back to final tax year, and what do? We assess, we include now all remaining periods, any and all remaining periods, and then deduct our overlap. So what we've now got is that other situation, hence this second example. We've now got 2 accounting periods that follow on from what was the assessment in the penultimate tax year. We've got one more year end, the 30th of June, before we continue to trade through to the 1st of December 20. So we've got those 2 periods now to include. So that's why we don't try in step 1 to say, so what's the assessment for the final tax year? Don't do it that way. What we do is, what is the final tax year? Go back to penultimate. It is always CYB. Are we left with 1 or, as here, 2 accounting periods that remain up to the date of cessation? And that period, or here periods, are then allocated to the final tax year. So here we go. In 2021, we have got, firstly, the year ended the 30th of June 20. That was a figure of £20,000. We've then got the period through to the 1st of December 20. That was, there's your 20,000 and now the final £10,000 figure. But of course, away from that, we must deduct, wherever we have one, our overlap profits, and it's known as overlap relief. They, as you can see there, were £5,000. Take them away. So we got a £20,000 and a £10,000 profit respectively, less the £5,000 overlap. We've got ourselves a £25,000 assessment for the 2021 tax year. Again, remember what we then do. The whole purpose of these bases of assessment was that for any tax year, whether the final tax year, any normal continuing tax year, or as we saw previously, any of the opening tax years, our objective was to find what figure of tax-adjusted trading profit would be included for that tax year, i.e. within the income tax computation. We know how to include the other sources of income, essentially on a received basis. Employment income, actual received. Dividends received, interest received. Property income, 99 times out of 100 now, and will always be, unless you're told to the contrary, a received basis as well. This one, the trading income, is the awkward little so-and-so that you need to spend time sorting out and learning, practicing those bases of assessment, most notably in the opening years. But I hope you agree here, closing years are so much easier. Now, remember the figures that we use here are the tax-adjusted trading profits. So in deriving each of these numbers, in every one of the examples we've had, whether opening years or now in closing years, what have we done? We've taken the statement of profit or loss for the accounting period. We have adjusted that net profit as per the statement of profit or loss, adding back non-allowable expenses, taking out non-trading income. And then, of course, in relation to the add back of depreciation, we've replaced it with our own, well, HMRC's own deduction, capital allowances. Take the capital allowances from the adjusted trading profit to give you tax-adjusted trading profit. These are the figures that we're looking at here. Okay, if I take you back to the notes, therefore, you'll see there that you've got one little example, example 5, to have a go at. Compute the assessments for the final tax years of trading as far as that available information will allow. You know the process. You don't need me to do that for you. Have a go at that, please. Once done, check through with the answer. Shouldn't be any problems, I trust. And then come back. And there's then just one more area to deal with so far as this lecture is concerned. And that goes back to what I was saying just a moment ago. That when we get the figures of profit that you see here, they are the tax-adjusted trading profits. For any given accounting period, we do the adjustment of profit exercise. And again, for any given accounting period, we do our capital allowances. We'll just point out to you issues that arise that you already know about, to be fair, from Chapter 5, but I'll remind you of issues that specifically arise regarding the calculation of capital allowances when dealing either with a new business startup or a business now ceasing to trade. But get that one done, make sure you practice, you've got the technique sorted before we then move on. So pause now, check out example 5, and then come back and join me. Okay, well, as we said, therefore, the figures that we've used to work the assessments, both on a basic CYB, opening years or closing years, of the tax-adjusted trading profits. And they, as we know, are after adjusting up the statement of profit or loss and then computing and deducting capital allowances. A capital allowance computation is prepared for an accounting period. Whatever is the accounting period, that's what we use for capital allowances. Now, how does that impact as regards a capital allowance computation? Firstly, here, as we'll see in opening years, and then as we have in fact already seen in the closing years of an unincorporated trade. Again, the introduction, just explaining to you there what we do. The capital allowances, as we've said, prepared for the accounting period. The tax-adjusted trading profit is after deducting those capital allowances, and that is the figure to be used within our assessments. Now, in opening years, a particular issue, the opening accounting period. It isn't necessarily, and in any exam question, it is very unlikely to be a 12-month period. That we've seen that when we start trading, it is much more likely as we go from any possible start date within the calendar year to whatever is then our chosen accounting date, that starting period would either be less than or more than 12 months. Once we've chosen the accounting date, then it's year end after that, until you get through to your cessation. So it's that opening, that first tax year. So it's not a problem, and it's something we already know about. Remembering that the capital allowances that need to be computed are, itchy stitch again, pardon me, firstly, AIA, WDA, then FYA. What do we know about AIA? It is, of course, 100% based on a limit of £1 million for a 12-month period. Now, if therefore the opening period is less than or more than, then as we dealt with back in the chapter, we have to time apportion the limit. Now again, any time apportion limit based on £1 million is still likely to be a whole lot bigger than any qualifying plant and machinery expenditure incurred in that period. But beware, you have to time apportion, firstly the AIA, based on your £1 million limit, based on the length of the accounting period. If it was a 6-month accounting period that we had, then 6/12 of 1 million would of course be 500,000. If it was an 18-month opening accounting period, then 18/12 times your 1 million, that'll be 1.5 million. Now again, given that the numbers are so huge, it's very unlikely to impact on the availability of a full 100% AIA for all the expenditure incurred by the business. What may be rather more relevant to you is the WDA, the writing down allowance, because it too is time apportioned. It is a per annum figure. On the main pool items, 18% per annum. On the special rate pool, that's 6% per annum, or eventually on a reducing balance basis, of course. But we're dealing with the opening period. Now let's think, what assets are we going to be computing a writing down allowance on in that first accounting period? I've already said that any plant and machinery that qualifies for AIA is likely to be well within our time apportioned AIA limit. So there's no residual expenditure to go into any pool. If of course there were, if that expenditure was huge in that opening period, then yes, anything unrelieved by AIA would go to the requisite main pool or special rate pool, upon which then you take writing down allowance. Now again, I think that's an unlikely proposition, given our current 1 million limit. But what other assets, of course, attract WDA that do not attract AIA? And that, of course, is motor cars. Motor cars, that do not have low emissions. Low emissions are kept separate. They're entitled to, we'll discuss it in a moment, a first-year allowance. But any other cars from 51 grams to 110 grams, then in excess of 110 grams per kilometre in terms of their CO2 emissions, those would then go either to the main pool or to the special rate pool, assuming they have no private use by the proprietor, and a writing down allowance would then be given. If, of course, we buy either of those two cars in emissions terms, and it does have private use by the proprietor, then it doesn't go to either of those two pools. It's a non-pool asset. So we keep it separate. But again, what is available? Based on those emissions, either the 18% WDA or the 6% WDA. And what do we have to remember here? We have to remember that the writing down allowance must also be time apportioned based on the length of the accounting period. So if we have, as said a moment ago, a 6-month accounting period, then the 18% per annum or the 6% per annum has to be times by 6/12. We'll get 6 months worth. If it's an 18-month period, then we'll get 18/12 of the available 18% or 6% per annum. Obviously, if it does have private use by the proprietor, then any figure computed will then be restricted in your capital allowances computation to purely the business proportion. So we do the full WDA first, 18% or 6%, with the time apportionment for the 6 months, the 18 months, whichever it may be there other than 12 months. We do that, get that figure, deduct it from the cost of that car purchased in that opening period, and then whatever allowance that came to, it is that figure that is then restricted going into your allowances column for this accounting period. Okay, that's what we have to do, therefore, in terms of any time apportionments. We're only time apportioning AIA and WDA. What we have here, of course, is that first year allowance is 100% on those low emission cars, and that's never time apportioned. We've got AIA and WDA, where the period is longer or shorter than 12 months, that then needs to be time apportioned as appropriate. Now, what I've done here is, rather than just give you, as you have already practiced, I think it was example 1 in chapter 5, dealing with a short opening period, I think it was there, and computing both AIA and WDA, What we've done is to give you a bigger problem, a sort of example of a Section C example, only there would be rather more work to do than you see here in example 6. But this is bringing your profits and capital allowances, your tax adjusted trading profit, into the income tax computation, because we have been asked to compute Wendy's income tax liability for 2019-20 tax year there. Okay, so what have we got? Until the 30th of June 19, Wendy was employed and had an annual salary of £40,000. Now remember, we're doing the income tax computation for 1920, so there's relevant information there. At the start of this particular tax year, at the start of the 1920 tax year, she was in employment at an annual salary of £40,000. And that was the case up until the 30th of June. So we've got, therefore, the April, May and June salaries that would be received and therefore to be included in the 1920 tax year's income tax computation. So we will need 3/12 of that to go in as employment income. What did she then do? On the 1st of July 19, commenced in self-employment, running a music recording studio. The following information relates to the self-employment from the 1st of July 19 to, well, very kind here, it might have been 31st of March, but it's the 5th of April 2020. Again, the examiner does sometimes get kind to you and give you such an accounting date for the unincorporated trader. Now, the outcomes, of course, whether it was the 5th of April or the 31st of March, would be one and the same. We time apportion to the nearest month. So whatever profit as adjusted for taxation, then whatever capital allowance is being deducted from that, that would be the tax adjusted trading profit for that opening period from your start date through to the end of the tax year, or whatever that tax adjusted trading profit figure is, that would also be the assessment. What is the basis of assessment in the first tax year? I hope you remember that. It's an actual. So whatever figure we get here on the tax adjusted trading profit for that accounting period, that is the actual figure for the first tax year. We include that. If we prepared accounts to any other date, of course, then you'd have to go through your normal bases of assessment in opening years and work out what the assessment for the 1920 tax year would be. They tell us what the adjusted profit is. Obviously, what you could have for this period, 1st of July 19 through to the accounting date of the 5th of April, rather than a given adjusted trading profit, you could be given the statement of profit or loss and asked to prepare, of course, that adjustment of profit yourself. So you may be required, going from the statement of profit or loss, as per Chapter 4, to derive that figure. And that figure, of course, is before taking account of capital allowances. So here, I'm not asking you to do the adjustment of profit, but I am asking you to do the capital allowance computation for this period from the 1st of July 19 to the 5th of April 20, that being the period for the accounting period. That is the accounting period. We do the capital allowance computation for it. So what have we got here? We've got the 1st of July 19, recording equipment. Now, recording equipment, that's just normal plant and machinery. That, therefore, would be entitled to AIA and would be a main pool item. Obviously, as soon as we've seen that the accounting period is 1st of July 19 to 5th of April 20, that, therefore, a period of 9 months, you would know that any AIA limit would be 9/12 of 1 million. Now, again, given that when you look at the expenditure items here, we're getting nowhere near that figure, the fact that 9/12 of 1 million is only 0.75 million is not going to restrict in any way the 100% AIA. So you'll have 100% AIA on the £30,000. If I skip through to the last one there, that was computer equipment, 2,600. Again, that is AIA. It would otherwise have been main pool, but we're clearly going to get the 100% AIA on it. The interesting transactions, of course, are, as ever, with cars. First one, on the 15th of August 19, motor car, CO2 emissions, 170 grams per kilometre. That's in excess of 110, so any writing down allowance, and it will only be writing down allowance that is available here, is going to be restricted to 6%. But of course, for writing down allowance purposes, time apportionment applies. So we'll have 9/12 times whatever the writing down allowance would be. So in relation to this particular vehicle, 170 grams per kilometre, based on the allowable cost, 14,800, it would be 6% as the maximum available writing down allowance, but that 6% would then have to be time apportioned based on the length of the accounting period. Having got that figure and deducted it from the cost figure, it is not the amount of writing down allowance that may then be claimed, because that must be restricted to the 60% business use. The next car, CO2 emissions are 105 grams per kilometre, so between 51 and 110, and therefore 18% WDA is available. This one used privately by an employee, so we don't care about that. That is no restriction in terms of the capital allowances available. Remember, as though to be fair we are still to see it, but in Chapter 9, Employment Income, we will see how we tax the employee in relation to the benefit of a car being provided for their private use. That will be dealt with as an employment income assessment on the employee. It does not restrict the capital allowances of the employer. Only when we're dealing with unincorporated traders, and as we have here, used by Wendy, the proprietor of the business, the taxpayer concerned, only then do we restrict to the business use proportion. What we do have to, of course, do with that 10,400, given it's 105, it will be 18%, as we've said. But remember, you won't get all of that. You'll reduce that to 9/12. And it is the 9/12 figure, as with the Wendy's car, that is the figure, the 9/12 figure, to be deducted from the cost to give you the tax written down value to carry forward to the next accounting period there. Okay. So in which case, I'd like you now to have a go at this and get your tax-adjusted trading profit, i.e. do your capital allowance computation, take it away from your, what was it, 89,000? Yeah, we got 89,000 for that period. Take your capital allowances away. That's the tax-adjusted trading profit. It also here is the assessment in that tax year, because the basis of assessment in the first year is actual. And we've prepared accounts through to the end of the tax year, so that is one and the same. It is the assessment for the first year. Put that into your income tax computation along with the other income that we are informed of, and calculate your income tax liability. That will therefore be a good revision for you, not just of what we have done in the more recent chapters, but again what we did back in Chapter 2 when we prepared the income tax computation. So you have a go at that, pause at this point in time, come back and we'll have a quick review of that. Okay, well, assuming you got the tax-adjusted trading profit correctly computed, the capital allowances bit was the only slightly tricky bit of this process, then you'd be looking at an income tax computation for the 1920 tax year that looks like this. We'd have our employment income, that was 3/12 of 40,000 as we knew. You had to work out that tax-adjusted trading profit. That was a result of the given adjusted profit, less the capital allowances that you went on then to compute. I'll come back to that in a moment. Given that that figure is correct, we include the trading profit as part of total income. It is also net income, from which we then deduct the personal allowance to, of course, give us taxable income there. It's a simple enough income tax computation, assuming you have identified the correct figure of trading profit. Tax calculation. No information about gift aid payments or personal pension contributions, and therefore the basic rate band limit stays untouched at its normal £37,500 figure. At 20%, all of our income, of course, as we've already identified, is non-savings. I haven't therefore bothered with a total column here because there isn't anything other than non-savings. The balance is in the higher rate band. Calculate your tax at 40%, add it to your basic rate, get your income tax liability. As we said here, as Wendy started to trade on the 1st of July 19, our first tax year was 1920. 1920 has an actual basis. That is the 1st of July start date to the following 5th of April. That doesn't span 2 accounting periods. It is entirely 1 accounting period, for which we'd made the adjusted profit of 89, but we need to deduct the capital allowances from that. So what have we got? We know that we prepare the CA computation for that, the accounting period. We don't prepare for tax years, though this happens here to be synonymous with the tax year. We prepare the capital allowance computation for the accounting period. The additions that qualify for AIA were, as we'd already identified, the recording equipment and the computer. That, of course, is a whole lot less than our maximum AIA limit of 0.75 million, and therefore we get the 32,600 AIA. We, of course, did have 2 other purchases. They were cars, one of which goes into the main pool. That was the lower of the 2 emissions, the one between 51 and 110. It has no private use by the proprietor, so into the main pool it goes. The other one did have private use by the proprietor. The business use proportion was 60%. It being a non-pool asset is separated out. Put the cost figure in accordingly. The writing down allowance. On your pool, which consists entirely, of course, of that car, £10,400 was the cost, times 18%, times 9/12. All being well, that is your figure there. Transfer across into the allowances available column and deduct in deriving the tax written down value to carry forward. The high emission non-pool car that we have here, high emission 6% writing down allowance, but again the length of that opening accounting period is only 9 months, so only 9/12 of that. Hopefully that then is the figure you get. But you don't get to claim all of that. All of that 666 is deducted in deriving then the tax written down value to carry forward. But of that 666, you only get to claim the business use proportion, 60%, and hopefully gives us that figure. Add up your allowances for the period. All being well, if the numbers are correct anyway, do check through. We've got 34,404. That came back to your working to be deducted there to give you the tax adjusted trading income figure to then go into the assessment for that first tax year, and indeed it became the assessment for that first tax year. Okay. Just one final thing to deal with, and don't worry, it's going to be very, very quick because we already know. In dealing with cessation of trade, you know that when you get to the final accounting period, that there will be no WDA, no AIA, no FYA in that final period of trading. And what we get instead is balancing adjustments that will arise on cessation. Now, if there are additions, as there may be, if there are additions in the final period, we simply add to the relevant pool, and then the disposal proceeds, remember, deduct sales proceeds to a maximum of original cost, are then deducted to find a balance. That balance on a pool or non-pool column, that balance will then either be a balancing allowance or a balancing charge. If the net balance is still positive, That will be a balancing allowance that will now arise, and that will be your figure of capital allowance available for the period. Subject to being reduced, of course, that if on any of these calculations, when you deducted your proceeds from your tax written down value, that net balance was a negative figure, then that would be a balancing charge. That would reduce the overall capital allowances of the period, and if we had overall a net balancing charge, well, instead of a deduction from the trading income to give you the tax adjusted trading profit, we would have an increase in that adjusted trading profit to give an even bigger tax adjusted trading income figure. We have already done an example on this, as we in fact have done on opening years as well. But if you look back to Chapter 5, Example 5, and make sure you're happy with how you deal with these capital allowances in closing years there as well. What you see here is as a rather smaller version of what could be what you need to do in a Section C question. We know that one of the 15-mark questions will be income tax. It doesn't always, but sometimes will, ask for an income tax computation. And there the two big areas are, as yet to be seen, employment income, or as we have now seen in terms of trading income, that the exercise might revolve around trading income, adjusting up the statement of profit or loss, computing and deducting capital allowances, using then the trading income you've got within a determination of the assessment for the relevant tax year, either the first tax year or maybe the final tax year. Put in any other income, whether that be employment income, as in the example we did a moment ago, or whether it be any form of the investment, the unearned income, whether it's interest income, whether it's dividend, whether it's property income. We include those on the relevant bases as well. And then you're into a full-blown income tax computation, going down to either income tax liability or income tax payable. There's plenty in there to give a 15-mark question. You've seen a basic example of that with the previous example that we did, but just practice again your closing year rules, because that too could be an equivalent exercise. There, of course, the capital allowances computation would be a whole lot easier, given the fact that, as we've just said, there's no WDA, no IA, and no FYA. It's just a matter of computing the balancing adjustments. Okay, have a go at that, therefore, review through, make sure you're happy with it, before again coming back to join us for our next, and what should indeed be the final session here in terms of Chapter 6.